What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with Jason Snyder. How are you doing today, Jason?
I'm good, Dan. How about you?
I'm fantastic, and I'll tell you why. I don't know if you're aware of this or not, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, buyers, sellers, all that kind of stuff. And you might ask yourself, why would you want to do that? And the answer is, if you've ever heard of an off-market deal, the private syndications sometimes call us 506B deals, then you should know that you need documentation of your prior substantive relationship, or else the SEC will get ants in its pants and force you to pay all of your investors back plus interest and yank your exemption. And that's not cool. So here we are. But before we talk too much about real estate, Jason, do you want to say a thing or two about yourself?
Yeah, no, thanks again, Dan, for having me today. Jason Snyder, been in the multifamily space about 20 years. Really from the ground up, started out, wanted to learn, single family and then gold private equity acquisitions. I landed there. And then after about 10 years in that space, decided to get out and do my own thing. And when I say that, use that term loosely, find the right partners, syndications, JVs, all multifamily.
I love it. I love it. So let's get started. The first segment we always go through, it's the five distinct motivations. Before I do that, I got to say, but wait, check your eight. Jason, I don't know how technologically inclined you are or if you have the ability or not, but maybe you can see through the camera and down there in the audience. There might be this hideous subscribe button in their device, and they should probably, do something. Okay, it's a stupid joke, but whatever.
Got me.
There you go. So the five distinct motivations. I've now interviewed literally hundreds of different investors, syndicators, deal sponsors, and whatnot, and everybody has their own unique why, but I found they fit pretty neatly into these five different categories. And the reason why it's so important to ask is because there are risks involved in this business, and we need to know, since it takes months to close a deal, it takes years to go full cycle, what's going to keep somebody from throwing in the towel when things get tough? And so I go through these in every episode. The first motivation of which is preservation of purchasing power. What on earth is that? Well, some people are out there who they are W-2 job optional. They don't have to work. And the reason that they can do that is because they have a portfolio of assets, and the proceeds of ownership are how they pay their bills. And so if somebody doesn't have to work in order to make money, why would they go through the hassle of making another big investment, another big acquisition? Well, there's a couple scenarios that stand out first and foremost. One is if inflation is rearing its ugly head, that's going to eat away from the purchasing power of the cash flow. And then the other circumstance is if there's an asset crash or just basically heavy distress, it means it's easy to buy at a steep discount. Now, everybody, regardless of where they are in their real estate journey, they should try to buy at the biggest discount they possibly can, especially because at the end of the day, you're trying to make money. But people in this position, they don't really have to make a move very often. And in full disclosure, I'm not to this point in my career yet. What I'm up to is a little bit different, abstract. I'm trying to trade time for wealth. And that all stems from the fact that back in 2014, I took my CRM agency, which is for mass emailing, online credit card transactions for online businesses that do seven figures or more in a year. And in 2014, I started working for an Ohio firm that was flipping 10 houses a month like clockwork for years before they hired me. And as I was watching how real estate works and learning from this real estate player, it hit me that the bigger your salary is, the bigger the tax burden you're paying. You're paying more tax than anybody else. So it hit me that I should pivot to where I'm getting rewarded for my efforts in little slivers of equity in multiple different projects instead of seeking a bigger and bigger salary. So that's what I'm up to. And I understand that a lot of youngsters, they find that too abstract. They don't know what I'm talking about to some degree. So the one that is really inviting for them and some other people, you could call it fast tracking retirement, but it might just be that you want to take control of your schedule. In other words, work fewer months per year or fewer weeks per month or something like that. A lot of people, that's what they're really after. And some of the people who have that sort of, scaling back sort of motivation, they think it's secretly everybody's motivation, but I assure you that is not the case. For example, there's the next group who's just plain ambitious. They want to buy their entire hometown. They're after that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And even though that's vilified in some circles, the fact is, if you want to have these nice places to rent, whether it's retail or office or actual residential, the fact is you need somebody who's going to keep at it and keep hustling to their 90s. And that's why these guys are great to be on your GP team. But the last group, they're also similarly motivated in the sense that they're never going to quit, but they've found a sector of society, or maybe it's animals, maybe it's the environment, who knows what it is, but they found out, hey, there's a great big financial component to making big changes in the world. And so that's why they're making their acquisitions. So Jason, when it comes to you, you mentioned you've been in this for a while. What combination of these motivations would you say describes you best?
I would definitely say the last one, yeah, help people who need it, right? Coming from the background that I did, we had a little bit of a chance, before we started off here today, and realizing that there are so many other opportunities to make money, not the traditional route, right? And most people, frankly, don't even have the opportunity or know somebody in the space to provide them with that chance to invest as a limited partner, right? And really put their money to work, what otherwise would be dormant, right?
I love that
That's
answer.
that's a big one.
Yep. I love that answer. It's absolutely fantastic. But one risk that we run whenever we do the motivation piece is that we might make it sound like it's easier than it actually is. And if you've ever been involved in one of these private syndications, these off-market deals, these 506B deals, then you should have been forced to fill out this suitability questionnaire. The securities attorney would have insisted on it. And if there is no securities attorney, you should run, not walk.
Get out of
Okay.
there.
But
Yeah.
in that questionnaire, I found there was one question that, for me, I felt it lacked utility. Basically, if I could, regardless of the response of the person filling it out, I don't think the answer is very usable. And it was the tolerance for risk assessment question. So I made my own one, which is fill in the blanks. There are many popular investment asset classes, but I think blank is too risky. So Jason, it could be inside real estate, outside real estate. You could do one of each if you want. What's too risky for you, though?
Oh gosh, I'd have to say Bitcoin right out of the gate. Obviously, a lot of headlines. Seems like it's sexy. Very opaque currency, right? The things that you're most afraid of are the things you don't know about. There's not a whole heck of a lot to know about. Where the exchanges, right? Those are new and fresh. I mean, maybe in time that's a great thing to look at as an alternative investment, but right now the volatility in that space, we have it everywhere else, but significant in that space, right? So that to me fits that blank for sure.
Yep, I love it, especially because, at the end of the day, the only play is an appreciation one. Buy low, sell high, or just lose.
You got it.
So hate to be the wet blanket, the rain on the parade, but while I'm at it, this next slide, I actually did not use it for the first couple hundred chance encounters because there are some people who are highly visible online and their role is more like a public relations or marketing role, and they don't ever have to really learn how to do projections, really understanding the underwriting, like every little bits of it. They basically know the headlines and they know what things mean. but they're not professional underwriters really. So I didn't want to embarrass anybody, but it hit me that, hey, everybody has to know some of the numbers of their deals, and they're going to say that some of them talk to their investors more than others. So for anybody in the audience who is listening and not watching, I'll read out the list. I've got 14 of them up here, and it's not an exhaustive list. Some people rely on other metrics, and you're welcome to add them, but here are the ones I have here. I got cash on cash, IRR, internal rate of return. I got cost per door. I got net operating income, or NOI. I got the going in cap rate, which is really talking about what sort of discount are you getting for that area, because every area at any time of any year will have a standard cap rate that things are going for. Then there's the loan interest rate, which is especially important if you're assuming a loan. Then there's the occupancy or vacancy rate. They're just inverse, so it's the same number, but the other way of looking at it. Then you have the average income where the property is located, the amortization period of the loan, especially if you're going to be assuming it. Then there's the market versus the in-place rents. What's the difference between those two numbers? There's the population growth, where the property is located. So you have some baked-in appreciation stemming from demand in general. Then you have the sponsor record, which has to do with how many deals have already gone full cycle and how many are on the go right now. Then you have the waterfall, split, or exit strategy. In other words, what happens to your investment after your capital has been returned. And then the last one I have here is DSCR, which is debt service coverage ratio, which is about how much of the revenue from rent is going out the door immediately just to pay for the loan. So Jason, you're free to add a different one, or do like a top three or something like that. What numbers do you tend to hone in on?
Well, I would say one that's not on there that I think is vitally important is exit cap, right? Because that is really what the guide is. I mean, folks that have been in the space for the last 10 years,
Mhm.
they could just throw in a compressed exit cap at 4 or 5%, 3.5% to make the IRR and everything work, right? You can't do that today, right? Because we're in such a strange environment. So exit cap, huge. I'm focused on cash, IRR, equity multiple, right? All of these other pieces play a huge component to it. But sizing today, investors want to see a 15 upper teens IRR, 20 plus AR, 2x multiple, and a 6 cash on cash, right? Some are dipping down into the fives now just because deals are so difficult and interest rates are higher, right? But I mean, I take all of these, but those are the keys for me.
Yep, I love that. And that's one of the other risks, right? You have an underwriter on here. He's like, what are you talking about? They're all important, and it's like, right? I'm just eating up that answer like a delicious subscribe sandwich. That's intense, isn't it? It gets me every single time. I'm so subtle with my reminders to subscribe.
Yeah.
But it also tells me it's time to pull out the Dan Does Deals Commercial Core Competency Cube, which has the 6 different core roles in a commercial real estate deal. And in every episode, I go through all 6 sides. It takes 2 minutes. And the reason for that, the real benefit you get from watching this episode, there's 2. One, you learn to more effectively communicate on the subject of commercial real estate deals, and you'll be able to understand how my guest fits into those. And if you're looking at the cube and saying, you know what, I really need me one of those. I bet I could explain this stuff really well if I had one. Well, the good news, it's completely free. You go to dandoesdeals.com, there's this big conspicuous looking button where you just click it and download it and print it out. And yes, you heard me right. I committed the cardinal sin of marketing. Never ever give away your freebie without asking for some sort of contact information. But me personally, I want you to print this out and I want you to practice explaining it, because I really do think your future in this sector depends on effective communication. So let's get started. The most visible people you generally see in a commercial real estate deal are repositioners. They are the public-facing people. They are acquisitions people, so they're looking at a bunch of different deals to find out which one's the best one. They're doing a bunch of paperwork. In other words, they're underwriting the deal. They're doing the arithmetic, the math. They have to find out, is this property even making the amount of money that the seller/broker claims it is? Because right? But I think the most peculiar part of being a repositioner, and keep in mind most people have to become a repositioner before they can take on the other roles, the most peculiar part is they have to have a big network of financiers. And financiers are lenders, people with capital, basically people who deal with paper and money and the owners of buildings. They don't deal with residents or anything like that, and they're not on the GP team. But repositioners have to have financier relations roles. Everybody has to know people who are able to deploy capital. And the reason is because cheaper money means the building is more profitable. It's that simple. You just need to get cheaper loans and then you've got a better business all baked in. So that's why they're talking to financiers all the time. But the next place a repositioner looks will be more intuitive. It's the operations. It's stopping those Benjamins from going down the toilet. But of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns. There's also a role for GPs, which is asset management, which is overseeing the operations. And I don't know if you know this about me, but I'm from the internet. So that means if I'm going to be on an operations team, if I'm going to be on a GP team, I still have to have a real contribution. And the things that I tend to contribute are the CRM automations, any kind of web assets that are necessary. And then the bigger one, if you understand real estate really, you understand that vacancy is the enemy. It is the deal breaker. Even if you are dealing with a bigger property where you outsource property management to a third party, if they can't fill those units, you need somebody on the GP team with some serious marketing chops to get those units filled. And that's one of the things that I throw my hat in the ring for when I'm on a syndication. But of course, there's only so much you can do with operations because, hey, it's a mature industry. So the next place a repositioner frequently looks to get that upside is the contractor team. They renovate the place. They make it nicer so that the next residents will be more than happy to pay more in rent than the previous ones. But if only things were that simple. You could go ahead and gold plate the toilets, but you're not going to get a return on investment. And that's just one of the many problems that comes from having contractor teams involved. And if you're from the internet like me, then you're going to need locals. You're going to need boots on the ground who can be there in an hour or two, because that will not be me. Okay, I'd still be stuck at an airport in an hour or two. So that local piece of the puzzle is huge. I know that in Texas, there were some foreclosures where that was the mistake they made, is they didn't even have any boots on the ground. It was just crazy and millions of dollars were lost. It's really sad. But anyway, let's do a hypothetical for the next part. Let's say you try your hand at being a repositioner. You're an engineer or a physician or an attorney or something. You see a 350 unit apartment complex down the street and you say to yourself, hey, I know how to buy a house. You put down your down payment, you borrow the rest. So you get your group of friends, you say, hey, let's throw in like 100K each or something and take the building over. So with full of confidence, you turn around to the financiers and say, hey, I want to buy that building over there. It's tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars you want to lend us, huh? But the financiers are going to have one question that I haven't answered so far. And if you're in a mentorship program or you have a guru or something like that, I highly encourage you to pay close attention to this next part, because the financier is going to ask, who's the KP? Who's the sponsor? What's that all about? So the reason why that hypothetical won't work is because you won't be eligible for a commercial loan unless somebody in the fold, one of the owners, already owns a similar asset. Okay, because after all, these lenders, they're taking depositor cash and lending it to you. They need to make sure that you're not going to just run the place into the ground and lose all of that depositor money. So that's why you have to have a sponsor involved, or a key principal. On top of that, you need a certain amount of liquidity. And then as far as collateral goes, the GPs all summed together, you need a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Jason, as far as those different sides, I imagine you wear about at least two hats. A lot of people wear about two hats anyway. But which pieces of the puzzle do you tend to focus on?
Definitely on the repositioner side. I mean, I've been in acquisitions related fields within commercial real estate, multifamily since the mid 2000s, right? When I was a broker at Marcus and Millichap, multifamily. And the most recent W-2, no longer with the W-2, but the most recent was 10 years at a private equity firm, was director of acquisitions. So, the deal hunt, finding the deal. I've done asset management, not good at it. I love to find the deal, love the broker relationships, lending relationships, direct to seller kind of stuff, right? I'm a hunter. Get the deal, package it up, hand it off to people that are smarter than me in the property management, asset management side, and let them run with it. So that's repositioner all the way.
All right. I love it. So let's talk about buy box then. And when real estate people are saying, hey, what you looking for? What's your buy box? What's your ideal property? We're asking about three pieces of information. First one's going to be geography. Where is it? Which state? Which county? Possibly even which neighborhood. It's going to matter. The second one's size. Now, most of my guests on this show are in multifamily, and the way that you define size in multifamily is by the number of apartment units. And the reason why it's relevant, why investors would ask what's the unit count that you're looking for, it's because that's how you define size. The type of team that will take over 10 or 15 unit apartment complexes are going to be fundamentally different from the ones that are taking over 150, 350 unit apartment complexes. So that size definitely matters. And of course, not all of them are going to, all the types of commercial real estate are going to be unit count. Some go by square footage or acreage, but that size is going to matter. But the third one is usually called class. And I don't like that term because it's kind of uncountable and it's two different distinct parts. So I like to say the word desirability and split desirability into the condition and the area. So if you're talking about condition, how old is the facility, the building, all that sort of stuff? How beat up is it? And then what sort of luxuries and amenities does it include? Okay, there's the condition. But if you're talking about the area, especially in residential, you have one additional feature, which is the school districts where the property is located is going to contribute to its value and desirability. But all types of real estate are going to, as far as the values go, are going to be dependent on the crime rate where the property is located. And then, of course, there's that old broker trope of location, location, location. I don't like that saying because I don't think it's very informative. I think it should be traffic, 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 because they mean if more people are passing by that property every single day, it's automatically more desirable. But both the area and the condition, they're ranked the same way as in grade school. So A plus is the top, and then A, and then A minus, and then B plus, and so on. So Jason, as far as your buy box goes, what's easy to say yes to?
Oh, let's see. Let's start off with 50 to 150 units, BC value add, 80s vintage and newer. We'll go down in the 60s and 70s if it's in a better location. Primarily secondary markets, not core. Um, with obvious economic drivers, want infrastructure in place, get you 30 to 45 minutes outside a major urban MSA on that secondary tier. Um, that's pretty straightforward stuff, right? I think. Yeah, I think that hit all, check 4 or 5 boxes, right?
Yeah, great. And you're as far as the states go, though.
Yeah, location. Sorry about that. Yeah. So currently Dallas, San Antonio, third tranche there's Houston, but that's kind of, third bottom of the wish list there. North Carolina, South Carolina, and in and around Atlanta for the most part.
Okay, beautiful. I love it. I love it. So then the next question is about people. And it's honestly my favorite part about this industry. I came from tech, and it's no secret that tech people can be a little bit antisocial. And real estate people are the opposite of that. I personally chalk it up to the fact that it's multifaceted. You got a team with these different roles. Nobody's going to be all six roles for any meaningful amount of time. And so because of that, they're going to be more than willing to give referrals, introductions, build new teams that they're not even going to be a part of or even profit from. It's a really fantastic thing. But even though there is that inclination, the fact is, we all have our own unique skill sets. So that means we're better suited for helping some people more than others. Me personally, it's always been the sponsors and KPs that I look for because, after all, I'm from the internet. And so I need somebody who already has a foundation of their business put together there. Because when you first start off as a repositioner, you need grunts who can put in 80 to 120-hour weeks. And that's simply not where I'm contributing the most. So I'm also always eager to speak to anybody on the die, on this cube here, just because of this interview series, and we're ultimately all in the business of deploying capital. So I'd be remiss if I didn't mention financiers. But how about you, Jason? Who are you best suited to help? Who are you looking to speak to? And if you have a 506B deal, don't mention it specifically, because that's not cool, especially
Yeah,
in the
no,
same
got it.
sentence as investors.
Yep, I hear that. Understood. No, so with the skill set that I've got, again, I'm looking for complementary skill sets. Looking for folks that are in the capital raise side. Obviously, in today's environment, that's the most difficult piece. I'm currently working on that muscle, if you will, as well to add to the acquisitions piece. But not good at it, right? So capital raisers. I do have some asset management folks in tow, institutional folks. However, if a team came with an established asset management team that had a track record, certainly would welcome that. Got a KP, but again, always looking for relationships. So kit and caboodle, all the above on that die, literally looking to connect, share some experiences and find out there's an opportunity to do some business together.
Perfect. I love it. And so the people in the audience must be thinking, then how do I reach out? And I'll sandbag that conversation by talking about myself a little bit. You'll see I have a very distinct last name, makes it really easy to find me on the internet, especially on LinkedIn, which is where I spend most of my social media time. Of course, if you go on to Amazon.com, I've got a few different books out on different business skill building related topics. And if you are going to be taking on investors, doing syndications, basically offering any kind of passive income to anybody through whatever work you're going to be doing, I highly encourage you can pause the video and scan this QR code. That goes to the FAQs page of 506BME, which is the platform where I offer the supplementary CRM service of documenting your substantive relationships. It's such a weird word. Your substantive relationships for when the SEC ends up asking, and they are not going to accept, I'm sorry, sir, my laptop fell in the bathtub, so I have no documentation of my substantive relations. So if you want that taken care of with the cloud and backups and all that kind of stuff, please do reach out. But Jason, if people want to reach out to you, website, social media, what are the best ways to reach out?
Yeah, certainly LinkedIn. Jason Snyder, as you can see here on the screen, SNYDER. Website, www.montclair, montclair-cp.com. Or you can email me direct, js@montclair-cp.com.
Beautiful, beautiful. And that brings me to the last thing I always do. It's not for you specifically, Jason, it's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs, like migraine-like symptoms, I'm confident it's all because of the downright hideous subscribe button that's just down there, and you can get rid of it for free. And it just does its thing. Full disclosure, I want a bunch of people to click on it, because if they do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. The trade-off to you, just so we're clear, my videos may show up on your list of suggestions. You can feel free to ignore those suggestions, because quite frankly, I just appreciate the fact that you spent this time with me. Just like Jason, I appreciate you joining me. This has been cool.
Likewise. Yeah, I really appreciate it, Dan.
Hey
Thanks.
there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.